All units, this is not a drill. Stop checking COMEX inventory. Stop reading the premium. Stop trying to time the bottom. What I'm holding right now happened 96 hours ago, and by tomorrow morning, three institutions will pretend it never existed. But I have their timestamps, I have their internal revisions, and I have the legal amendments they pushed through at 11:43 p.m. when they assumed nobody was documenting. This isn't market commentary. This is a blueprint of institutional panic. And what it reveals is simple. The metal they promised you isn't where they said it was. Not all of it, not even most of it. 96 hours ago, three separate banking giants rewrote their customer agreements in complete silence. No announcements, no investor calls, just surgical edits buried inside terms and conditions documents that account holders will scroll past without reading. HSBC made their move first. JPMorgan followed 14 hours later. ScotiaBank closed the circle before sunrise. If you believe that timing is random, you've never watched what happens when the architecture starts cracking beneath trillion-dollar positions. Financial institutions don't coordinate legal language across continents at 2 in the morning unless something fundamental is breaking. And when you examine what else moved during that same window, a vault drawdown in London that pulled 17 million ounces without explanation, an emergency session between LBMA members that appeared on no official schedule, pricing distortions where morning silver and afternoon silver split by margins that defied every arbitrage model, you stop wondering if there's a problem. You start calculating how much time is left. Let me walk you through exactly what changed in those documents, because the moment you understand what these sentences actually mean when translated from legal protection into operational reality, you'll see this week for what it was. Not risk management, survival protocol. HSBC inserted one specific clause into their precious metals custody agreements. Here's the exact wording. The institution maintains discretion to impose limitations on physical metal withdrawal requests based on prevailing availability conditions, market volatility factors, and internal operational thresholds. Read it again. Prevailing availability conditions. This is your silver, held under your account, with documentation carrying your legal claim. And now they're stating availability might become conditional. How does availability ever become a question mark when the asset is supposed to already exist under your name, unless the asset was never actually isolated in the first place? Most investors operating through institutional silver accounts believe their holdings are sitting in vault storage with identification markers, specific bars, serial numbers, segregated inventory. That's the illusion the account structure sells. But here's how it actually functions. When you purchase silver through a banking custodian, you're not acquiring metal, you're acquiring a liability entry, a numerical claim against their collective pool. They accept your capital, credit your digital ledger with ounce equivalents, and operate on the assumption you'll never demand physical conversion. And the part they don't advertise in the product literature, they don't maintain enough tangible silver to satisfy every outstanding claim. Not half, not a third. A custodian bank might service 8,000 clients who collectively hold positions representing 6 million ounces on paper. The actual inventory sitting in their designated storage may be 900,000 ounces of deliverable metal. They're running a probability model. Betting statistical patterns show you won't all arrive simultaneously demanding what's yours. It's identical to the fractional reserve game traditional banks play with currency deposits. Your account balance displays numbers, but the institution doesn't keep that cash in static reserve. They deploy it, lend it, invest it. The system remains functional as long as mass simultaneous withdrawal doesn't materialize, until probability breaks. What shifted dramatically in the final quarter of last year is that confidence evaporated. Withdrawal demand from bullion banking accounts exploded by 370% between September and December. That's not organic fluctuation. That's systematic flight. Retail participants who watched the London Metal Exchange unilaterally cancel nickel contracts to prevent billionaire losses, who saw GameStop positions mysteriously vanish from brokerage accounts, absorbed a lesson institutions hoped they'd ignore. Digital promises disintegrate under pressure. Physical possession survives institutional failure. Industrial users accelerated the pressure. Solar manufacturers, medical device producers, advanced electronics companies, They abandoned just-in-time inventory philosophy and started demanding immediate delivery of 6 to 9 month reserves. And then two sovereign wealth entities, Middle Eastern capital that doesn't negotiate twice, initiated complete withdrawal protocols after their independent auditors identified reconciliation discrepancies in account documentation. When sovereign money loses faith, that signal propagates through the entire ecosystem like structural failure spreading through a foundation. Here's the mathematics that should alarm anyone tracking this system. Total reported silver inventory across London vault facilities currently sits around 891 million ounces, but the aggregate value of outstanding paper claims, contractual obligations, and derivative exposure against that physical base? Conservative industry analysis estimates between 3.6 and 4.2 billion ounces worth of promises. That's a leverage ratio hovering near 5 to 1 on cautious assumptions. Some derivative specialists calculating gross notional exposure suggest closer to 7 to 1 when you include second-order instruments. Basic arithmetic reveals the fragility. If 28% of claim holders simultaneously demanded physical settlement, the system experiences complete inventory depletion. There simply isn't enough metal. And based on current quarterly withdrawal trajectory analysis, we're tracking at 24%, 4 percentage points from critical threshold. The policy amendments these institutions just implemented aren't defensive measures, they're emergency containment. Focus on HSBC specifically. They operate what's technically classified as the world's largest commercial precious metals vault facility, 187 million ounces under custody. That's 19% of total London market inventory. They also serve as primary custodian for SLV, the dominant silver exchange-traded fund on the planet, claiming to hold 463 million ounces backing shareholder positions. When HSBC modifies fundamental access terms, that's not regional policy adjustment. That's the system's gravitational center transmitting distress. Here's what they actually changed. Previously, customers holding allocated silver accounts, meaning inventory with specific bar identification and serial number assignment designated to that account holder, could initiate withdrawal with 5 business days advance notice. Standard procedure: request submitted, inventory prepared, logistics arranged, transfer executed. The revised terms extend that notice requirement to 30 business days for any request exceeding 50,000 ounces, but the critical addition comes in the follow-up language. HSBC now reserves unilateral authority to extend that timeline beyond 30 days based on operational constraints and metal availability assessment. Pause there. Metal availability assessment. For allocated accounts, these are positions where the entire structural premise is that your silver is already separated, documented, and waiting under your legal ownership. It's not integrated into their operational flow. It's supposed to be segregated inventory with your identity attached. So why would availability ever require assessment, unless the metal they allocated to your account has simultaneously been committed elsewhere? A contact inside HSBC's Precious Metals Operations Division revealed what actually triggered these changes. December brought 3 massive withdrawal requests, combined total 89 million ounces. 2 originated from sovereign wealth funds. 1 came from an Asian industrial conglomerate. When HSBC moved to execute these deliveries, they encountered a problem. 26% of the bars listed in their database as fulfilling those allocated account positions couldn't be immediately located in physical vault inventory. Some had been leased to third-party institutions, and the internal tracking systems weren't synchronized. Some showed serial number conflicts between digital records and actual stamped identification, and some bars had been assigned to multiple customer allocations simultaneously. Identical physical silver promised to different legal owners. HSBC spent 7 weeks scrambling. They paid 38 to 47% premiums above spot pricing to secure emergency deliveries from refineries. They ultimately satisfied all 3 withdrawal demands, but the experience exposed something they couldn't ignore going forward. Their custody infrastructure was fundamentally broken. The 30-day notice requirement isn't about transportation logistics. It's about buying time to locate or acquire metal they've already documented as existing. Now examine JPMorgan. They carry history here. In 2020, They settled with federal prosecutors for $920 million over charges their traders systematically manipulated precious metals markets for nearly a decade. Multiple employees received prison sentences. The institution admitted criminal conduct. Logic suggests after that outcome, they'd reduce metals exposure and operate with extreme caution. Instead, they expanded. They currently operate one of the largest COMEX registered silver vaults and maintain the biggest commercial short position in silver futures among all U.S. banking institutions. Federal regulatory filings show $8.7 billion in precious metals derivatives exposure. The same day HSBC amended their terms, JPMorgan modified theirs. They targeted the conversion mechanism specifically. Previously, customers holding unallocated silver positions could request conversion to allocated status for a 2% administrative fee. This represented the escape route, the method to transform a paper promise into documented physical ownership. The new terms make conversion requests subject to approval contingent on metal availability and operational capacity evaluation. The fee structure jumped from 2% to 5.5%. And new contractual language grants JPMorgan authority to suspend conversion programs entirely during periods classified as elevated market activity. Translation: if you're holding paper silver exposure through JPMorgan and you want to convert that into actual documented metal ownership, they can now deny your request without providing justification, charge you nearly 3 times the previous rate if they approve it, or simply shut down the entire program during precisely the market conditions when securing physical control would matter most. They're preserving physical inventory for COMEX contractual delivery obligations, not customer conversions. Failing exchange delivery triggers regulatory enforcement. Telling individual customers no is just customer relations management. ScotiaBank went beyond restrictions. They completely suspended new unallocated silver account origination. Program closed. Existing account holders now face monthly withdrawal caps of 10,000 ounces, reduced from 100,000, and every withdrawal request, regardless of size, requires 60 days advance notice, 2 full months to access metal supposedly held on your behalf. Internal Scotia documentation explains why. A memo from their precious metals division shows they've been operating their unallocated pool at 9-to-1 leverage for at least 37 months. For every physical ounce in actual vault storage, they've sold 9 ounces worth of claims to customers, and their own internal analysis concluded that if current withdrawal behavior patterns continued unmodified, their physical inventory would reach complete exhaustion in 4 to 7 weeks, total depletion. The 60-day notice requirement isn't policy philosophy, it's mathematical necessity. They need to throttle withdrawal velocity below the rate that exposes insolvency. 3 institutions, 48 hours, nearly identical restriction frameworks. I don't have evidence of a coordinated conference call between executive teams, but all 3 are LBMA member institutions. All 3 participate in daily London silver price fixing mechanisms, and the LBMA conducted an unscheduled member meeting on January 12th, 48 hours before these amendments appeared, that was never published on any public calendar. If you believe fractional precious metal systems are immune to actual collapse, history provides definitive correction. This exact pattern has materialized before. The London Gold Pool, 1961 through 1968. The United States and 7 European nations formed a consortium dedicated to defending the $35 per ounce gold price that anchored the entire Bretton Woods monetary architecture. Whenever market demand pushed prices higher, the 8 countries deployed gold from national reserves to suppress it. For 7 years, the strategy functioned. They commanded sufficient combined reserves to overpower private market demand. By 1967, the mathematics inverted. Private demand grew so massive the pool was hemorrhaging metal, 120 tons per day during peak stress periods. France withdrew from the consortium, unwilling to sacrifice reserves defending what they recognized as an indefensible price level. On March 15, 1968, the pool collapsed. Member nations announced cessation of gold sales to private buyers. Within 14 days, gold jumped from $35 to $48. Within 3 years, dollar-gold convertibility ended entirely. Gold reached $870 by 1980. The lesson, price suppression through physical metal sales, works until inventory depletes. When failure arrives, repricing is violent and compressed. The Hunt brothers in 1979 understood this mechanism. They accumulated over 130 million ounces of physical silver, purchasing futures contracts and demanding delivery. Their strategy was elegant. Remove available metal from system circulation. Silver went from $6 to $51 in 14 months. COMEX faced existential crisis. Traders who sold short positions couldn't source metal to fulfill delivery obligations. The exchange was approaching mass default that would obliterate futures market credibility. On January 21, 1980, COMEX implemented Silver Rule 7. They banned new long position establishment. Only liquidation permitted, making it illegal to purchase silver futures on what was supposedly a neutral marketplace, crashed prices from $50 to $11 in 9 weeks. The Hunts went bankrupt. But the critical insight isn't their personal outcome. It's what institutions will do when delivery demand threatens to expose paper market inadequacy. They'll destroy market integrity before allowing system failure. February 2021 provided the modern demonstration. Wall Street bets identified silver as structurally vulnerable following GameStop. Coordinated buying overwhelmed dealer capacity within 72 hours. Premiums hit 43% over spot. The U.S. Mint reported demand exceeding anything in their operational history. Paper prices briefly touched $32 before retreating. Media declared the squeeze unsuccessful. But something happened that most coverage ignored. SLV, the world's largest silver ETF, amended its legal prospectus with language stating the trust might be unable to acquire additional physical silver due to supply disruptions. The custodian of the biggest paper-silver vehicle formally acknowledged in regulatory filings they might become unable to source deliverable metal. The structural vulnerabilities exposed that week are precisely what banking institutions have been preparing for since. We're currently in Phase 2 of a 5-phase systemic breakdown. Phase 1 was premium divergence, already complete. Throughout the second half of last year, physical silver premiums expanded from normal 5 to 7% over spot to 28, 37, sometimes 42%. When buyers willingly pay 42% above official pricing to obtain real metal instead of paper exposure, they're delivering a verdict no institution can reframe. Phase 2 is access restriction. That's now. Banks extending notice periods, implementing withdrawal caps, adding discretionary denial provisions, everything documented in this analysis. Expect additional institutions implementing similar frameworks in coming weeks, dealers extending delivery timelines further, government mints announcing production suspensions or allocation limitations. Historical analysis suggests Phase 2 duration runs 2 to 5 months, but each successive phase has compressed relative to previous cycles. This might complete in 6 to 9 weeks. Phase 3 is exchange delivery stress. COMEX and LBMA begin displaying visible fulfillment dysfunction. Settlement periods that contractually require 30 days extend to 60, 90 indefinite delays. Exchanges implement emergency position limits restricting delivery demand. Margin requirements spike exponentially, making delivery positions economically prohibitive. We'll recognize Phase 3 arrival when media reports delivery delays or exchanges announce mid-contract rule modifications. The technical indicator, COMEX registered inventory dropping below 95 million ounces while delivery demand maintains elevation. Current level is 133 million, approaching threshold. Phase 4 is price discovery breakdown. Paper and physical markets fully decouple. COMEX quotes $38 while dealers with actual inventory charge $95 or $120. The paper market becomes recognized as fictional pricing. Exchanges may declare force majeure provisions, suspend trading, mandate cash settlement at administered prices rather than physical delivery. This happened with nickel on the London Metal Exchange in March 2022. The exchange retroactively canceled billions in executed trades rather than permitting market clearing at prices that would bankrupt major participants. Phase 4 produces extreme volatility, 25 to 40% moves in individual sessions. Current trajectory suggests second or third quarter timeline. Phase 5 is architectural reset. Regulatory authorities intervene to construct new structural frameworks, mandatory physical backing requirements, comprehensive position limits, restructured delivery mechanisms, entirely new infrastructure. We cannot predict what post-crisis architecture looks like, but current systems are demonstrably failing. Historical precedent suggests full stabilization requires 2 to 6 years. After 1980, silver normalization took 4 years. After gold pool collapse, 6 years. If you hold physical silver in direct possession, your responsibility is conviction and patience. The volatility approaching will test both. Paper prices may collapse while physical premiums stay elevated or expand further. That's not a signal to liquidate. That's the paper market failing to represent physical scarcity. If your silver sits in bank-safe deposit boxes, understand banks can restrict vault access during declared emergency conditions. If stored with third-party custodians, verify your account structure is allocated and segregated, not pooled, and confirm independent audits exist with recent dates. Consider whether direct physical control provides security that institutional storage cannot guarantee. If you've been evaluating physical silver acquisition but haven't executed, several realities need acknowledgement. Premiums are elevated and will likely remain elevated or increase until supply conditions normalize, which could require years. Waiting for premium compression means waiting for conditions that may not materialize before phase 3 and 4 disruptions arrive. When purchasing, prioritize recognized sovereign products with established global liquidity. American Silver Eagles, Canadian Maple Leafs, Austrian Philharmonics. Recognized branding facilitates liquidity when eventual liquidation or exchange becomes necessary. Avoid paper silver instruments entirely. The substance of what's been documented here is that paper claims are inadequately backed by deliverable physical metal. ETF shares, futures contracts without delivery intent, unallocated account positions, all carry counterparty risk that institutions are actively struggling to manage. If you want silver exposure, own silver. Paper referencing silver is fundamentally different with fundamentally different risk profiles. Expect delivery delays. Dealers currently quote 6 to 10 weeks. Those estimates may prove optimistic as demand continues accelerating. Here's what we know with certainty. 3 of the world's largest bullion banking institutions simultaneously restricted customer access to silver holdings this week, quietly. Through legal modifications 99% will never read. They implemented these restrictions because internal operational reality reveals they cannot fulfill obligations if withdrawal demand continues. The fractional system operating for decades is experiencing stress the institutions themselves recognize as unsustainable. The access restrictions aren't precautionary measures, they're institutional admissions. What develops next depends on how rapidly the remaining phases materialize and how prepared you are when they arrive. The information exists, the pattern is visible, the timeline is compressing. What you do with this understanding is the only variable still within your control.